Today, we're breaking down the DR Range Contraction Model on Bitcoin and Ethereum, where one tiny detail made a massive impact on decision making. Don't miss it. In this overnight DR session on Ethereum, a small detail made a huge difference for decision making. If you've been following closely, you'll know that even Ethereum follows the DR principles we've discussed in a lot of videos. And this trade perfectly showcases those dynamics with some special details. The day began with a DR range contraction model, as the ADR formed inside the previous day's RDR. Both sides of the RDR had already been played before the overnight DR session started. At 3 a.m., the overnight DR session opens below the aftermarket DR session. What does this tell us? Well, if you said this excludes a DR upside model formation, you're absolutely correct. This is a small but crucial insight that can guide your decision-making early on. As the overnight DR session forms between 3 and 4 a.m., it closes as a green DR box. At this point, the probability leans towards either a DR downside model or a DR range expansion model, which means we need to remain cautious even if we see a long confirmation. We understand the long confirmation, however, with the DR downside model technically still intact, it prompts us to manage expectations carefully. Lower in the range, we highlight a previous DR session level and a magnetic volume imbalance which could act as a magnet for price. These are crucial levels to keep in mind. Price retraces and initially rejects the DR high and closing price, but then the critical candle forms. Let's zoom in a little bit, as it's very important. This candle crosses the ADR highs with its wick, hinting already that the DR downside model might be invalidated with a very high probability. Wicks are already a good indication for that, but later then, this candle closes above the aftermarket DR highs on a 5-minute time frame. This is your most important signal for the session, as it increases the probability for a DR downside model being broken drastically. With the downside model invalidated, we now fully focus on long setups. Price retraces back into the defining range and sharply rejects from here. What is it rejecting? It's the ADR mid-level, presenting a potential first entry for the session. If this setup fails, you already know the next high probability area deeper in the range. Turning on volume imbalances, you'll notice a previous imbalance holding price in this zone, adding another layer of confluence to the trade idea. For targets, the next standard deviation level of 1 is the obvious choice. But given the session's characteristics, aiming for the 1.5 SD level is also reasonable. This level offers nearly 4R while covering the IDR mid with your stop loss. As price pushes higher, it briefly retraces, creating another opportunity. Below, we see 2 open volume imbalances alongside 3 previous DR session levels stacked together. If not already positioned, this is another valid entry point with high confluence. Price continues higher, hitting the target and ultimately taking out the aftermarket DR session highs at the session's close. Now here's the key takeaway. That single candle breaking the aftermarket DR highs was the most informative signal of the session. It provided the clearest indication that long trades had the highest probability of success. Let's take a look at another example on a Wednesday aftermarket DR session from Bitcoin and fully break it down. Yes, you can apply all the IDR characteristics to Bitcoin as well, and this trade is a perfect example. The aftermarket defining range formed inside the previous day's regular DR session, which, if you followed my videos, is what I refer to as the DR Range Contraction Model. This model suggests that price is likely to squeeze in one direction before making the real move. However, at this point, we still don't know which direction the breakout will occur, as there hasn't been a confirmation candle closing outside the range on a 5-minute time frame. Remember, these DR model characteristics are a high probability guideline, not a guarantee. Nothing in the markets is 100%, otherwise everyone would be a billionaire by now. Once we get a confirmation, like in this case with a close above the range, our focus shifts to long setups. The green DR box further strengthens the probability of seeing upside price action throughout the session. Now, let's think about targets. Standard deviation levels are always a good point of reference, but with a DR range contraction model, it's very likely that the previous day's DR session levels will at least be revisited. The previous day's regular DR IDR highs are a great target here. If the market shows strong momentum, you could aim for the highs of the previous RDR session, but keep in mind that this carries lower probability and acts as a sensitive area for price. With that in mind, it's smart to highlight previous DR session levels that align with the current defining range. In this case, we have one from the previous day's ODR and another from the previous day's RDR, with it covering almost the entire range. For now, we will toggle the bigger one off and keep it in our mind since it overlaps with the previous day's ODR level and could act as a critical point of sensitivity for price. Everything's now set up, so let's wait for a retracement. 40 minutes after the confirmation, price retraces back into the defining range, stopping perfectly at the closing price and the previous DR session levels. This provides the first valid entry, with stops placed below the opening price and the IDR mid. This trade offers a solid 3R potential when targeting the previous day's RDR/IDR highs. Price moves higher but eventually returns to the upper levels of the defining range. If you miss the first entry, this offers another great opportunity. Price reaches the 1 standard deviation level and shortly after retraces again to the initial entry zone. Once more, price rejects the closing price and the previous DR session level, with the retracement low still intact. This provides yet another potential entry point. As the session comes to an end, you can either move your stop loss to break even or close the position in profits. And there you go, a well-planned and executed trade yielding a solid 3R profit before the overnight DR session begins. Re-engineering trades like this is critical for sharpening your skills. Pay attention to small but crucial details. They are often the deciding factor in whether a trade aligns with high probability setups. I can't emphasize enough how valuable it is to backtest and re-engineer previous sessions. By reviewing these patterns repeatedly, you train your mind to recognize them instinctively as they form in real time. This is how you bridge the gap between hindsight analysis and confident execution. Don't forget to check out my previous videos, where I guide you from DR Basics to advanced setups. These patterns repeat over and over. Master them, and you'll find yourself steps ahead of the market. Leave a like if you want more frequently uploaded breakdowns like these. I hope to see you in the next video and have a good trading week.
We're gonna take on the world.